Megan, thank you so much for joining us here at FundForum International. You're an economist and you can look at historically what's happened in the past and perhaps make predictions for the future. I know it's difficult, but what would you say asset managers need to be most aware of at the moment and for the coming 12 months?
So I think this synchronized global recovery that we really enjoyed last year is probably coming to an end. So I think investors do need to be cognizant and discern a bit more between developed markets in particular. So the US should continue to go on full steam ahead because we have so much fiscal stimulus coming down the pipeline through the tax bill and the spending bill. But Europe actually does seem to have slowed down, largely because of higher oil prices and a stronger dollar. So that's been a real headwind for Europe. Japan actually contracted in the first quarter of this year. I don't think that will continue, but I do think that we can expect weaker growth out of Japan. And I think China's probably slowed down quite a lot in the first half of this year as well. Now, the government there has a ton of tools to prop growth up, so I'm not concerned about any of these regions. I don't think that we're careening for a recession or a downturn, but I do think that we can expect GDP growth in a lot of these regions to decelerate towards potential GDP growth, which we really should have expected anyhow, the one exception being the US, where we're sort of goosing the system with stimulus measures for the next 2 years, and then the US should also decelerate.
So you've talked there about a slowdown, but this cycle does seem to be defying previous ones in that it is a bit different.
Yep. So this business cycle is a lot longer than any other business cycle. I think most economists who think that there might be a recession in 2019, 2020 will say, well, we're just kind of due, because the business cycle on average is sort of 10 to 12 years. I think this time around, every time you would have had a normal repricing of capital goods and labor, it would be so incredibly painful for every level of every economy that central banks keep stepping in to avoid it and pushing in more liquidity into the macro system. And so I think they've extended this cycle. It's been a weaker cycle. The recovery has been pretty tepid across the developed world, at least. But I do think this one can last for a really long time. So I think all economists can agree we're in the late stage of the business cycle. We just disagree on how long that can last, and I think it has legs, so I think it can last a couple more years at least.
In light of what you said there and the perhaps unusual central bank role, will that bring its own problems, do you foresee?
So it could do. You could find bubbles, certainly. So given that so many central banks have been buying up assets, it's really distorted markets. And there are a couple of examples. In the US in particular, student loans, car loans, those are clear bubbles. Will they be systemic issues if they burst? I sort of doubt it. Much more worrisome is non-financial corporate debt. So in the US, we've been on an absolute debt binge for the past year. And that's okay as long as rates are really low and corporate profits are really high. But actually, given that we're in a rate hiking cycle, that could become problematic, particularly if you look at the corporates that aren't sitting on tons of cash. So if you strip out tech and pharma, the remainder look really highly leveraged. So I think that could be a problem. And in my view, that's probably the most likely cause of the next recession. The next recession doesn't have to take out a bank, though, so I don't think the next recession will look like the last one, knock on wood. I do think it could be shallower and shorter than the last one, but I do think it will have something to do with leverage, given that we don't really have a sustainable growth model without leverage in the developed world.
So that's the economic situation we're in. What other factors could come into play in the future, such as the geopolitical situation? We've just seen no communique at G7, it's quite extraordinary times. What impact do you think that will have?
Yeah, so I think geopolitics can come in, or just straight politics as well. You mentioned the communique. It's the first time we haven't signed a communique after a G7 meeting. Now, those communiques tend to be pretty toothless, so it's not a huge deal that we didn't sign one. It's just symbolic. The U.S. also was utterly isolated on the UN Security Council last week in a vote on Gaza. It's the first time ever the U.S. was alone in voting the way it did. So there are a bunch of signs that the U.S. is increasingly isolated, and at the same time, we do have a bunch of geopolitical risks out there. They've been out there for a while, and investors have stopped kind of figuring out how to hedge or trade around them. So things like North Korea, and I don't expect much to come out of the North Korea summit, but also the South China Sea, a number of potential skirmishes in the Middle East. If they were to break out, I think the U.S. will have a harder time finding allies in terms of responding, and even from our traditional allies, unfortunately. And so that could have an impact on the impact of those geopolitical skirmishes.
So the U.S. isolation itself is likely to make a difference?
Yeah, that's absolutely right. So our normal allies who we would usually turn to, we have been sort of poking them in the eye with trade in particular. So that's the EU, Japan. Japan never got an exemption from our steel and aluminum tariffs, but they've been a long-standing ally. That's strange politics, really. The EU is quite upset about a lot of these trade skirmishes as well.
And do you think those trade skirmishes, as you described them, will turn into something more significant as well, potentially?
I do think that they probably will. If you look at the economics of it, it does not make any sense to be looking at bilateral trade balances. The one issue that does make sense is that it's unfair that China's stealing IP, essentially, and I think a lot of other countries are sympathetic with that argument, but tariffs are not the way to go about that at all. So economically, it doesn't make a whole lot of sense, but politically, it does make a lot of sense. I think particularly in some of the swing states, these messages really resonate, and we're in a midterm election year in the U.S. That being said, even once the elections are over, I don't think our trade policy will change significantly. So I do think that these trade skirmishes will probably get worse before they get worse. I do think that they are just set to escalate from here on out.
So there's 1,500 delegates here at the conference. What do you hope they'll take away and you can impart while you're here?
So I hope that they can take away the benefits of volatility that we're seeing in the markets, even though it can be quite painful as well, but also some of the risks up ahead. I mean, every market was up last year. That's not supposed to happen. We've been living in really unusual times, low volatility again, and there are real opportunities now that you've got volatility and you've got divergences between developed markets and emerging markets, but I think trying to understand some of those differences is really important in investing.
Come and listen to you and some of your warnings, if you like.
That's right, exactly, yeah. Some of the risks that I've been highlighting.
Megan, thank you so much for joining us. It's been great to talk to you.
Thanks for having me.